Hey, this is Sasha. Thanks for joining me here in this episode. And what I want to do is share with you a trade idea when it comes to trading an option setup. And what I'm doing here is to share with you some insights on the option trading membership that I'd like to release very soon. So I want you to give me some feedback and thoughts and ideas on what you think I'm doing right, what you think I'm doing wrong, what I can improve on, what I could be more detailed on. All about these option trades and strategies. And what I want to do is just go in detail, share with you some thoughts and insights on maybe a trade setup that I would put on or think about putting on, when I would do it, when I would take profits. And that's really what my goal is to open up your eyes to different strategies, ideas, and concepts that you could do when it comes to trading options. Anyways, let's kind of get started here with some ideas, and I'll show you a trade setup, an idea that I could go ahead and put on here on Tesla. We're gonna do kind of a bearish butterfly spread. So let's kind of get started and move forward. All right, so I'd like to first take a look at kind of this concept or this diagram here. And that is because I want to break things down for people who are brand new. So first off, the strategy that we're going to look at is going to be a butterfly strategy, and I'll explain to you why. And this strategy is really going to look something like this. So this is what we're looking to do. Now, before we get there, we want to evaluate market stock conditions and kind of the VIX. So we need to understand where is it that we are. So, are we looking at all-time highs or are we pulling back? What's going on with the overall market? So first off, I'm going to check out the S&P, and you can see as we pull back a bit right here, hey, this market was fairly at, low points, a little while ago in December. And then we've shot up, pulled back a little, shot up, pulled back a little, and continue to really make higher highs. And you can see this market now continues to stretch and be stretched. So it's not that we're at super all-time highs, but almost within, I would say within a few points, within 10 or 12 points of all-time highs, because we're right there. We were at all-time highs and now we're pulling back. Now, with that in mind, I'm looking at Tesla as well. So look at Tesla. What's been going on with Tesla here? Shot up, right? This stock was selling off, came down here, found a little bit of a bottom, popped, pulled back, kind of isolated for a little bit. And then we got gaps, huge gaps, popping and again popping. And I think by the looks of it, this stock continues to stretch because we have one gap, two gaps, and really it's just like a rocket ship. Now the volume is still there. That looks good and healthy, but I think a small little pullback could happen. So that's what I want to exploit a little or do a slight little trade on. So I want to show you an example here. Here is actually the trade that I did just a day or so ago, just so you can get an idea. And this one is working out really well as the trade pulls back. I got a 5-10-5 spread on the butterfly, put it on just a little bit higher, and it's pulling back and it's doing quite well right now for me. So we are up $127 on about $725 of capital. So if you do the math, that is a pretty good percentage. So when we look at it, about let's say 150 divided by 750. So looking at it already, we're up 20% on that trade in just a handful of days. So that's the trade I want to show you here. And first off, let's hide these positions and we'll go back onto our paper to get an idea of what we're trying to do here. All right, so market conditions, we are at highs. Okay, so that's the first big thing we need to understand. The second thing we need to understand is where is the VIX? And if I look at the VIX right now, the VIX is right here kind of near low. So I'm expecting a downward move as well. Now I could play this from the volatility standpoint saying, hey, volatility may go up. And you could say, well, hey, why don't you do a calendar or a spread, something like that? Well, butterfly is a little more cost effective in that way. And really decay happens pretty quick and rapid. So that's why I'm kind of looking to do more of a butterfly. So here, as we check this out, the VIX is at lows. So when we look at the VIX, it's kind of at lows. So I'm expecting a little pullback. Now, where does this trade fit in? Is it a speculative trade? Is it an income trade? Is it a long portfolio? From my standpoint, this is a speculative trade. And the reason for that is I'm looking to put this trade on, the current prices somewhere right here. And I'm looking to go ahead, put this trade on. So that way that stock pulls back a bit, and with time, what happens is that profit picture or that line continues to grow, and hopefully in the next 2 weeks, this will pull back. And when that pulls back, I go ahead and capitalize from that movement, which means I don't have to spend a lot of money. Basically, I'm spending about $100 here to potentially make, I mean, you could say about, I think anywhere between $30 to $40. Doesn't sound like a lot, but on a percentage-wise, that's a 30% or so return on an investment. Of course, I could multiply this times 5 contracts, and all of a sudden you get more, 10 contracts, 20 contracts, you get the idea. So anyways, what I'm looking to do here as far as the delta goes, okay, what do we want price to do? When the delta goes here, we want it to go down. Okay, so we want prices to go down. Theta is going to be positive. Now, it could be negative as we continue to go over here and as we get very close to expiration if this thing doesn't move. But in reality, the majority of this trade should be a positive theta, with the exception of kind of if it starts going a little against us. And Vega, we actually want volatility to go down because this is going to be a short Vega trade. But remember, when stocks sell off, okay, volatility usually goes up. So it won't really help us that much. But remember, we're going to capitalize much more so on the direction of the trade from the delta and the theta. So volatility, as long as it doesn't hurt us too bad, which I don't think it will, when we have these the delta there, we should be okay. Now, profit-wise, where do we want to take profits and where do we want to get out as far as losses? We're going to take a look at that here in a second after we do the trade setup. So let's go and take a look at this trade right here. I'm going to go and set up a Tesla. I want to go ahead and do this trade because as you look at Tesla, it's really at all-time highs. I don't know if it's going to pull back in a week, 2 weeks, 3 weeks, but I think within 2 to 3 weeks, it should pull back a little bit. And that means I'm looking for probably 14 to 21 or 28 days. So let's just say about 24 days would be nice. If I go too short, it may not, I might not have enough time. If I go too long, I'm paying more and the time decay doesn't really kick in a little bit. So in this case, if I go 24 days out, that might be nice. And the strikes I'm looking at is somewhere between, I would say between kind of 35 and the 25 range. And the reason for that is because if I go, let's say 47% probability in the money, well, if I go with that, then in that case, it could just blow past my strike. If I go way further out, something like a probability of 15%, all of a sudden it may never reach there. So between 35 and 25 may have a chance of at least kind of moving back or pulling back without spending too much money. And these are just the probabilities of going in the money. So if I go somewhere around the 330, 327 and a half, 325, let's just say 325 or 330, that could be an interesting place. So what I'm going to do is go ahead and buy a butterfly at 325 on the December 6th, and I want to protect myself about 1 to 2 strikes out, and I like nice even numbers most of the time. And you can see this setup right here. We're risking $28, but I might want to go a little bit further. So let's say 335 and 315 on the protection side. So now when I look at this trade, okay, and I look at analyzing it, I'm at the 325 strikes. So that's a 28%, which means, hey, it's got to pull back quite a bit. So all we needed to do is go down about 10 points and we should be okay. Now, remember, with time, that theta decay will creep in, and notice this profit line right here. The profit line's way outside of this expiration line, and that's the whole power behind this butterfly trade. And I'm risking $103 on this trade, $103 only for a speculative directional trade. Of course, you could do more contracts or you could widen things, but $103 to potentially, let's say, hey, maybe this will happen in 4 or 5 days or so. And if we pull back, you know, you're risking about $102, $3, and you're looking to make about 50. So when you look at that, 50 divided by $103, you're looking at what, 48%. So that's huge return on investment. But of course, if it goes against us, well, now if it goes to, let's say, 360 and pops, I might lose out 40, 50 bucks. So it's a shot. It's not a guaranteed shot. It's not a ton of money that you're risking, but it's a little shot, make 60 bucks. But if you start multiplying this, let's say we go to 5 contracts right here, you're risking about 515 to make about, 200-300 bucks. So I'm looking for, 48% seems a little greedy. So let's shoot for 30%, even if it doesn't reach there, on a $510 trade. If I'm looking at a $510 trade and I'm looking for about a 20% return, 100, 150 bucks, 200 bucks would be nice. And that means even if it pulls back a little bit, that should be just good. But if it continues to sell off, you're not risking too much. And that's a nice percent on the return. So let's make a quick little plan here for this. Okay, so I would take profits. So let's say we're doing this trade. We're gonna put on this a $500 trade. Call it 515, 525. I probably would want to do profits anywhere between let's say 150 to 200. Let's just aim for something like that. Where do we get out of the loss? Really, because this is a speculative trade, it could be a full loss in a way. But normally what you would do is look at this and say, hey, well, I need probabilities to work in my favor. I don't want to lose the full 500, but let's say, okay, well, 375, 400 is kind of where I want to go. And at minus 400, I'm still keeping about $100 there. And that's basically double of this. If I did 200, it wouldn't really let the probabilities work in my favor because I'm just trying to let those things work in my favor. So as I look at this trade, even after, let's just say 1-2 days, going to a negative $200, $300, $400 loss, this stock is at 360. So if I start seeing it's moving against me or it's a $300-$400 loss, I'm out. Otherwise, you're looking for this thing to kind of come back into it a little bit slowly with time, risking, $510 to potentially make here just in a couple days. And let's just say it happened in a few weeks. You could make literally, if it gets 510, comes back, and even overshoots 460, you could almost make a 1-to-1 return on your investment. So that's kind of what I'm looking at as a trade setup. I don't know if it's going to happen. As I've been talking, this trade's kind of been, stocks continue to be going down, so we could have been in an even better position. So I'm going to go ahead and put it in right now just to get things going, and we'll see. And that's kind of the basic trade setup. I'll go ahead, put that in the account right there, and we'll see here how this plays out. So cancel, replace, we'll go ahead, bump it up a couple bucks, put it in there, and see how that trade works out. So I got a couple positions on here now. So the trade we just put on was the December 6th one. So it's this one right here. It's, starts off a little bit of a negative right away. Here is the other one I put on a few days back. And you can see it's coming in, and it's doing its thing. And now you can just let it sit and allow that time decay, that theta, to kind of work for you. And if you look at the Greeks, you got a -8 delta, so you make a little bit from the delta. The theta's, about $28 a day, and the vega is negative. So of course we want volatility to actually go down, but as it sells off, it's really, volatility is going to pop a little bit. So in either case, the delta and the theta is really what's doing most of the heavy lifting. So I hope you found this video helpful, gave you some thoughts and insights. Give me some ideas on what you like about this breakdown of a strategy, of an option strategy like this. Do you like this kind of stuff? Do you like this kind of content? Do you want me to go in more detail? What things am I missing? If you're giving me a thumbs down, do 2 thumbs down, so that way I really know you hate the video, and also add a comment so I know what you can do to make this video better. Other than that, thank you so much for joining me. Keep an eye out for our options membership plan, which you could go ahead and make sure you get notified when it's released by clicking the link here, or of course subscribing to our YouTube channel right here. Thanks again, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.